How's it going, everybody? Gonna be talking about ETFs in this video, kind of my point of view. Obviously ETFs and everything, it's a pretty big topic, so like this is just again my perspective and I guess my interpretation of what the asset is and how it should be, I guess, incorporated into a portfolio. I guess that's a really fancy way of saying it. So in this video we're gonna be just discussing ETFs. I'm gonna probably bring over some things from Google in a second, but in short, I guess this is a good time to bring this over. My overall arching view of ETFs is, I gotta figure out how to phrase this properly. I like the asset for investing in a specific idea, or for example, if I wanted to invest in consumer staples as a whole, but I didn't know which stock to invest in, or better yet, let's do energy. I don't know what oil companies, I don't know what electric companies, or like even uranium, like what energy companies and stocks are good, so I don't know which one to buy, so I'm good. But however, I feel that the energy sector is, let's say, undervalued, or is expected to grow a good percentage in the following years. I want exposure to that ETF without taking on extra risk of any individual stock, potentially, just not managing their finances or capitalizing on that market share increase. I would do that by buying, let's say, the XLF. So I go to the XLF, this is the Spider ETF, is it the Spider? Yeah, and have that market exposure to, XLF, they lie here. I'll find out, XLE, yeah, I'm like, it's the XLE. I can have exposure to the energy sector without taking on the risk of any individual company, So that is my nice view of it. I think more mainstream people, they think, or not they think, but let's say the SPY, right? You got the SPY. You could buy this ETF, it tracks the SPY, obviously. You could also buy, let's see, is it VWO? No, not VWO, it's VOO. VWO is the Vanguard version of the S&P, and it tracks it, so it's essentially the same thing. I guess just to kind of quickly compare, let's say 23% down, let's go to SPY. I'm just curious how exactly it mirrors it. 23, yeah, it's basically 1-to-1, so how do you decide that, again, this is a big conversation, I'm kind of going to be jumping around and stuff, but, so why would I buy the SPY over or why would I buy VOO over the SPY? And I guess it depends on the expense ratio and how much the entity selling the ETF is charging for you to own it. I think Vanguard has the lowest rates, which is why people go to them for longer, I guess, investment time periods, but in general, ETFs are low. If they're 1% or above, that's a bad managed ETF, or they're overcharging you to hold that asset. So definitely take a look into that, and it might not seem like a lot, even if it's 0.5%. That might be a little low, but usually you want it really, really low. I would definitely read the prospectus of the individual ETF you're looking for to see what their goals are. It's a big paper, so you don't have to read it all, but you should be aware of what the goal of the ETF is, how they're, I guess, managing the money. Are they reducing or increasing the amount of shares X amount of days? One example is the GLD. I did read this, so this is the Spider ETF that tracks gold. Now, it's not 1-to-1, that's the thing to consider, and man, this conversation is going to get pretty long and maybe in depth. When I was reading the ETF, so what they do is, in order to pay their, not employees, but pay people, whatever, the money to do the ETF, whatever their reason is, every, let's say, year, they either increase the amount of shares or they reduce the amount of gold and sell that is actually on this ETF or whatever. So in short, if you hold this for, let's say, 5 years, essentially your shares are getting diluted more in a sense, and you're still also paying the expense ratio, which, actually, let me see if I can look it up real quick on the Yahoo Finance. Let's see, GLD, let's go to performance maybe, is it risk? No, it's risk. just for comparison what's VOO, because I know all the Vanguard ETFs are low. Went to profile. Yeah, 0.04, that's so low. So that's pretty good. But GLD, so on top of this 40.4%, I guess, sorry, I don't know why I keep saying, my brain is just not on right now. On top of the 0.4% thing that I have to pay per share, or whatever, the ownership of the ETF per year, in GLD, I'm also getting reduced by, let's say, 1%. I don't know, just making up a kind of a number. So I have to track that into my, like, investing, I guess, ID, because if the ETF goes up, let's say, 5%, like, in a year, right, well, minus 1% and minus, like, 0.4, so I'm technically losing X amount of percentage, which it adds up, so it's important to take note. So I guess just recapping what I said, check out the prospectus for each individual ETF. They will be different. The expense ratio is also important. One thing too, so let's say, this is what not that I never understood, but let's go to VO, right? Let's also open up another Yahoo Finance and go to, do I want to do SPY? What's another one? We'll get into leverage ETFs and stuff in a second. I'm trying to figure out another one like the SPY that isn't the actual SPY. I guess we're gonna have to be. Now let's just do that one. So let's just do the SPY. So it's like, why should I buy the SPY or should I buy VOO? Obviously, it doesn't really matter in a sense because it's the same assets that track the same market. But let's see, expense ratio on SPY is 0.09. Expense ratio on VOO is 0.04. The holdings turnover is a little different, so does that actually matter? I'm not entirely sure, but it's something to consider. But typically, if it's tracking the same market or, let's say, sector, that might be a little different. If it's tracking the same market and the expense ratios are different, you kind of maybe want to go with the one with the less expense ratio. However, there's obviously might be a reason why this is slightly higher. But for, let's say, this is tricky too, I gotta be careful with my wording. Let's say you want to buy like the XLE, the energy ETF. Well, the thing obviously to do would be go to the XLE ETF, check out the holdings. I mean, you can obviously do this many ways. I'm just on Yahoo Finance. And go down to their actual holdings. So 23% of this whole thing is ExxonMobil. Then it's Chevron, Phillips. So we're already like 55%, even more, because we have Marathon Petroleum, Phillips, whatever, in oil. So this is, I mean, that makes sense to me because oil went up so much in the recent months, or I guess years, that it makes sense that most of their holdings are in oil. But another thing to do is go to other ETFs that are tracking the energy sector and compare it. Kind of curious what this expense ratio is, 0.10, 13% turnover, which I guess makes more sense because of the volatility of the energy sector. So I guess inputting my own personal opinion really quick. Like, I don't care to own ETFs. I own some in different accounts, or a different account, not different accounts. I'm not that rich, or I'm not rich, but I would rather go to these ETFs and see what assets they're holding, and kind of pick and compare certain companies and see which one fits me better and do a little bit more due diligence. And I just find it fun, I guess, and it's more, not rewarding, but I like to own individual assets as opposed to entire sectors. Or ETFs exposing the entire sector. I just think there's more risk, more reward. I mean, obviously more risk, but you manage that risk by doing the research, which again still has risk, but I'm just saying I'd rather do that. So I would, yeah, I guess let's do this really quick. Forgot to mention this, I wanted to compare the SPY holdings to the Vanguard ETF, or the VOO. This should be exactly the same with almost the same percentages. So we have 5.9% Apple, we have 5.9% Apple, we have 5.9% same companies, and it makes sense because it's tracking the same market. So yeah. So when people are, I guess, what's the word I'm looking for? Like fighting or comparing, like should I buy this ETF or this one or this one? It doesn't really make sense to me because if you look at the individual assets in that ETF that it's tracking or that they're holding, it's like the same thing. And again, it just kind of comes down to what's the expense ratio and what is the overall market, I guess, or sorry, not the market, the overall mindset of the company managing the ETF, which I mean is not really managing, right? If it's just very, it's more passive, I guess, managing. But yeah, most important things for that. Let's see. There's probably some other stuff I wanted to mention about this, but let's go to like leverage. Actually, I want to mention this QYLD. I don't know if anyone, you guys probably have heard this before, but this was some ETF yielding like 11% for like since its inception, whatever. What it does, or if I remember correctly, actually, let me QYLD. They buy options, so they're yielding 13% right now. Wow, sounds really good. Covered call ETF automatically. So this is a more, in my opinion, this is such a risky ETF that I would never own this. Doesn't matter like what it or how I guess promising it seemed or how cheap it got, because it's a covered call ETFs. I guess this is a good point too that I want to bring up. For an ETF in my portfolio, if I were to buy one, I want it to target a specific sector. I mentioned this before, but I wanted to fine tune what I'm talking about. It either targets a specific sector that I don't understand or don't know how to value, so like the REITs, or like say mortgage or insurance. I don't know how to value that. But let's say I wanted exposure to it, I would buy an ETF that tracks that. This way I gain some exposure and market share without taking on the individual company risk. The other thing I would do is make sure that it's less volatile, I guess is the way I would say it. I don't want to invest in a risky ETF because to me, I could just buy like a company or something. I don't know. The point for me for investing into I said I a lot there. And the point for me of investing into ETFs is the passivity. Is that even a word? The less risky part of the portfolio should be the ETFs. Something like QLD. This thing is an options-based ETF. That is like, bro, I'm not touching that. Let's see, holding. So, I mean, again, so this still has like the same things in the SPY, which also makes kind of sense, but they're not gonna say it in the profile, though, are they? Yeah, you're gonna have to go to the actual prospectus. I don't know if I like open that up. This is growth, and so yeah, that makes sense. Actually, I always love reading these conversations. I'm guessing they didn't take the show either. Too many thoughts. So, how this works is they bet pretty risky stuff on options, and they promise a high payout ratio. And if the market's doing good, yeah, this makes sense. When the market starts doing bad, this thing does really bad because it becomes very risky. And in a sense, you are shorting stuff too in this ETF for the people like probably managing it, but that doesn't make it like, that makes it even more risky in my opinion. So like my friend was like, dude, this thing's been stable at like 20 something bucks, 21 bucks, and I support it. I'm like, yeah, but look at the asset, it's trash. And I don't know if he actually bought, I think he ended up buying it, but I mean, 13% yield sounds very nice, but sure, you're losing all of a sudden 25% of your value really fast. Now, granted, things have fallen fast, so I'm not picking on this individual company, or this individual ETF. I'm just saying, the essence of the ETF is just risky. People could do what they want, but I wouldn't want to touch that because it doesn't fit my investing, I guess, goals when I buy an ETF. There's things like, this looks bad, but it's actually, it's how it works. This is SQQ, so this is the short version of the QQQ. So is this new? Yep, wait, that's TQQ. So these are leveraged ETFs. What this means is so SQQ, if the market goes down 1%, this goes up 3%. TQQ is if the market, sorry, if the QQQ market goes up 1%, this goes up 3. So it's leveraged 3 times. If it sounds great, like, oh my gosh, the market is gonna be, I know the market's gonna be in 20 years, like, higher. Like, I think that's pretty obvious. It should most likely be a little bit higher due to inflation, due to, like, growth of businesses, stuff like that. However, this ETF is not, these ETFs are not meant for long-term holding, and what I mean by long-term holding is anything above 2 to, like, 3 weeks. Obviously, you can see if we go to the max, oh, it looks really great because the market's been running up, but let's go to SQQ. Where does it go? You got like this, and it's like, well, whoa, what's happening here? Well, what's happening is how this ETF is managed. Every, I think it was like month, I think it's less than a month because it's options based. So that makes sense too. How do you gain that leverage in an asset? Well, you have to bet riskier and I guess have the time element applied to that. So the way you do that is by doing options. So this ETF is sort of like QYLD, whatever, in the sense that it uses options to, I guess, get some sort of return. The reason why, since it's options based, and anything options based has a time element, these assets have very, very quick turnover. Or sorry, this asset has a very big turnover. So I think if we go to the holdings, I'm kind of curious, where is the asset turnover? Why am I not seeing it now? This is weird. Alright, so the expense ratio is already getting pretty high, but that makes sense because of the, I guess, management, or there has to be someone continually managing this every few weeks to buy or sell the dividends. Wow, I can really talk to them, I'm sorry guys. Buy and resell the options. Because of that, every X days, X weeks, in essence, your shares are getting less valuable on a, oh my gosh, how do you explain this? Like if you bought this at $55, right, today, and in 1 month, it still is at $55, you technically lost, or you're losing real value of the asset because of the, I guess, cycling of the money. In the prospectus, they answer this a lot easier, and they specifically say to not use these vehicles for long-term investing because of how the ETFs are managed. It's been a little while again since I read it, but I recommend if you're interested further, I would definitely read. These are great for trading vehicles if you think the market's going to do something in X amount of days or X weeks. But anything over a month, I would be hesitant to hold it for that long period of time because you're just, the innate value or the value you bought it at has went down because of how the ETF is managed. Let's move on to a little bit different topic in ETFs so I don't keep rambling about that. I think owning ETFs is important for most people's portfolios. The only thing is, I think most people, it depends. I think most people should own majority of ETFs because of the, like, low maintenance of it. But I think there's just so much opportunity to spend a little bit more time, either watching some videos or reading books and gaining a little bit of knowledge that you can do the research to buy certain companies that you like. The big thing that again messes people up is the mindset and the, I guess, ignoring your human reaction to certain things. Like this market's dropping, it's pretty obvious. The market is dropping. People are selling really good assets, even at pretty decent values. They're not pricing certain things in, and I get the market could still drop. I'm still predicting the market's going to go down here. But thinking that's based on, like, people's reaction to falling prices. And some assets are going to get worse, but some actually have value now, and they will get cheaper. And it's like, okay, how do you value the business and the growth, and how do you put, like, a market cap on that? ETFs are important, and I think owning ETFs in certain sectors that are kind of heavily, heavily pushed down could be pretty good. Like the XLE, looking on like a huge time frame during COVID, this was at like 20-year lows, almost a 20-year low, at like 15-year low. Sure, it could go down more, but as an ETF saying, okay, I think energy's in a weak sector, energy's in a weak state. I think energy is still a good area to be exposed to financially and from an investment point of view. I don't know what assets are good, but I'm gonna buy some because, hey, energy's good. Now, obviously, hindsight's 2020, but I don't need all this data to tell me, wow, this is really, really pushed to the downside. And again, it could stay low and it could remain low. Let's see if we get like an example. That's the tech. This is consumer staples. So this is metals. Metals hasn't done like anything. Not anything, but it hasn't done a lot. We're kind of in like the intermediate zone. However, again, during COVID, it's like, okay, metals are almost at like all-time lows in the, at least for the ETF. Maybe I should pick up some shares of this because it's cheap. And I mean, like, you can use like price action, you can use whatever you want to value it. I think price action is kind of good for these ETFs because the, gotta use that word, careful wording too, but the value of the ETF relatively should be the same for year to year, from like a holding point. Like if all the companies in the ETF do good, or the person managing the ETF is always going to expose the ETF more to the companies that are more promising, then they're probably going to add more shares to that, and in essence, the ETF should just be, again, I think it comes down to the asset turnover rate. If the asset rate is relatively high, then that means that the companies are getting rotated out that are bad, and the ones that are good are getting put more in. Again, you gotta read the prospectus, but I'm just saying, something to consider. I think that's a good way of looking at ETFs too. I think I stopped watching the videos, but there's just so many videos on YouTube where it's like, buy this ETF or this one, and you look at the assets and it's the exact same thing. It's just people talking about it, and there's like nothing really to talk about. It's just you're buying the market. And the thing too with this is a whole conversation. I think I referenced this in like another video, but if you're only buying the market, you're only expecting to get what the market returns. For some, that's fine. They're gonna be happy with their like 5 to let's say 7% annually over like 50 years, which isn't bad. But again, like for this is almost an exception up here. I'm just saying. This conversation's gonna be a whole different one, but you can beat the market just because some people on YouTube say you can, and they show you some graph and say this. Like most people, there's a great argument. Most people don't beat the market over like a 10-year period of time, and the answer to that is they don't have to. If the market goes up, let's say 7% every year, that's great. If I beat the market 10% one year, 20% the next, like 40 the next, and then like negative 10 the next, I am outpacing the market insanely. We can actually, let me pull something up. Let's go to Dish. Let's see, just as an example. Let's say the market's at 1,000, right? Let's say the market, here we go, is 7% every year. Just do some nice math. Let's do 2022, and then let's just do 2022 plus 1. Let's do the next, we do 10 years. Yeah, looks like we got 10 years. We'll just barely get there. Now the market's obviously not going to do it. I hate when people say 7%, because if you do the math, it's not really 7. It's like 5. Or it's more like 5, 10, like 15, negative 20. don't beat the market the first year. Let's say I do. Actually, can we get percentages here? You know what? I'm sorry. Let's bring this to a different sheet. I don't know why I'm being dumb. Let's say that I don't beat the market the first year. Let's say I'm dumb. Typically, yeah, I didn't beat the market first year at all. Now let's say I base the market. Oh, nice. Now let's say I do like 10%. Let's do 15 because I'm doing good. Let's say I do 1. Let's say I do another 10% year. Let's say I do 20. Or not 20, that's a little optimistic. Let's say I do 7. Let's say I do 2. And I'm actually going to keep it that. Let's see what happens. I'm curious. And I'm dumb because I forgot to put all the decimals. Alright, I'm going to clean this up a tad bit. So we have that, and then now we want this to be, that's fine, this needs to go here, this needs to go here, that makes about sense. Let's see if it stretches down, sure, and round it off because who cares. Let's do the same thing here, that makes sense, it's rounded down. So, according to my thing in this year, yeah, we're doing good. And actually, if we do a percentage, how do we do this? That minus that divided by, let's do that. How much more are we beating it by? We're beating it by about 10%, 9%. Cool. Not like life shattering. That's pretty good. But now let's say, can we do 5%? Let's say we do like 7%. Maybe this is what the heck is this? Maybe this is a bad example. But to me, this is showing you don't need to beat the market every single year. Most people actually, this isn't the thing I wanted to do. Hopefully you guys are asleep by now. What I wanted to show was you didn't need to beat the market every year over 10 years. If you only beat the market this many, actually I wanted to keep this. If you only beat the market for this long, 1, 2, 3, 4 years, you're up 15% compared to the market, which is, from an investment point of view, insane. Maybe I didn't, hopefully I explained that a little well. I'm tired, guys, as you can probably tell, but I enjoy talking about this stuff. ETFs, I have a whole discussion about this too, where I think I phrased it a lot better. One thing I want to tell you about too is, just because, let's say for me, my portfolio is an example. Let's say you look at my portfolio, you're like, hey, you haven't beaten the market in 5 years. Well, it's like, okay, maybe the market's not wrong, but maybe, okay, great example. The last year, 2 years, tech has went absolutely up, like Apple, you got Google, all this stuff, right? And any ETF that tracked or had Apple in the portfolio, did very well. And if you say, oh, you didn't beat the market these last 2-3 years because you didn't own tech XYZ. Well, as a portfolio, or as me buying individual companies, I'm not saying that I want or I need to beat the portfolio every year X percentage. I'm saying one theory or thought process to have is I'm buying these basket of goods about companies that I think are undervalued and have good value. In 10 years, 20 years, I think my portfolio will outpace the market, let's say to 1 or 2% a year. Any individual year, I might be off by a lot. But maybe in like 40 years, maybe I'm doing better. And again, it's going to depend on the investor, what they think is best, what they think is wrong. ETFs offer good, I guess, bang for your buck. But I just don't like the idea of, I don't know, or not that I don't know, I don't own the assets that I specifically want. It's just getting, I guess, managed for me in a sense. Why isn't this loading? And because of that, I just would rather buy and pick the individual stocks. I think I kind of harped and rambled enough about this topic. I think I might have to redo this video soon about when I'm actually in a good state of mind, but when I'm like coherent. But definitely let me know down below some ETFs and I can look into them and maybe read a little bit more stuff. We can read the prospectus. You guys will be bored. You'll get knocked out. That thing is feel like I said what I wanted to say as good as I wanted to do it.